question. You can revise IFRS 16, IFRS 15, IFRS IS 40 and IS 2. Okay, so there are a lot of good things, a lot of new things. So let's start. Aderinto company constructs a residential building to sell and rent out. Okay, so there are two things they do. They sell it and sometimes they rent it. Okay, it prepares its financial statement using IFRS accounting standard. It has a financial year end of 31st December X5. Yes, important information. Year end is also always important for financial reporting paper and strategic business reporting paper, right? Okay, then the following exhibits available on the left hand side of the screen. Yes. Okay, so total three issues, total three parts of this question, A, B, C, and total three exhibits. Let's start with the easiest one, that is question number 1, and this is greenhouse gas emissions. Okay, nowadays hope you have seen my class regarding sustainability standards. So this is the hottest issue nowadays, but yes, it is linked to IS 37. It is linked to IS 37, pure IS 37. So this is, you can see on the screen, this is your exhibit number 1. Greenhouse gas emissions. In May X5 at Aderinto's annual general meeting, the directors announced to the shareholder that the company was committing to reducing its scope 1 net greenhouse gas emissions by 80%. So they are going towards sustainability. They are going towards reducing greenhouse gas emissions by 80%, which is good for the environment. Okay, so that this thing they announced in the AGM, in the meeting, right? The director also announced 2 ways to achieve this. Now, directors said, first they said that we'll reduce the greenhouse gas emissions by 80%. Now, how we'll achieve this target? How the directors going to achieve this target? Okay, in 2 ways. Number A, most GHG emissions, GHG means greenhouse gas, right? GHG, short form, on construction sites are related to the burning of diesel fuel. So previously, or I would say currently, they were using diesel fuel. So you know, diesel fuel creates a lot of pollution. Diesel engine creates lot of pollution. Aderinto will therefore invest in battery energy storage systems. See the new system they are planning, battery energy storage system. So it's going to be a capital expenditure. They are going to buy fixed assets in future. Okay, now for use in construction site to reduce reliance on energy from diesel fuel, Aderinto intends to order several of these systems at a cost of $10 million for delivery between 2006 and 7. Listen, if you have done basic accounting, I would say not advanced, basic financial reporting, FR level. So if you plan to buy any fixed asset, in future, you cannot make provision now. If you plan to buy a fixed asset in future, you cannot make provision now. Why? Because there is no present obligation. There is no obligating event. There is no present obligation. Company can easily take U-turn. Company can easily reverse his decision by not buying it, by not ordering it. So there is no obligation. Obligation means you have to do it at any cost. So here you cannot book provision. Okay, but you will see later in this next paragraph that they have booked the provision. Okay, so remember this 10 million. The directors have stated that despite these investments, all construction projects are still expected to make a profit. Okay, so one more thing is important, that this is a profitable even after the investment of this $10 million. still the company is going to make profits. So company is in profits. So this is not just an outflow. This is not just an outflow of 10 million, but company will also getting a lot of inflows more than that. Okay. So what is the treatment of this first paragraph? Battery energy storage system, very simple. You cannot make provisions at all. If you are planning to buy a fixed asset in future, you can't book provision now because it's not confirmed. And there is no obligating event. Hope you have studied the IS 37 class. In the IS 37 class, normally all teacher teaches this issue, that in history, in past, people used to book fake provision. People used to book fake provision, and then they later on they used to reverse it by and booking an extra income. So people were doing earning management through IS 37, but now it's not allowed. After the introduction of IS 37, it's not allowed at all. Okay. Next, to the extent that the use to the extent that the use of battery energy systems does not reduce scope 1 net GHG means greenhouse gas emissions by 80% compared to the current levels, Aderinto will then buy a carbon credits in each of the years 2006 to 2009 inclusive. Now this is very good. Listen, you know what carbon credits are like? Carbon credit certificate. Carbon credits, like, just for a kid, I would say it's a donation. It's a donation for saving the environment. Okay, just for your easiness. So what it is written, their first plan is to buy battery systems. Okay, and they are sure that if they buy battery system, they will reduce the net GHG, net greenhouse gas emissions, by 80%. But now in the second paragraph, they are saying, what if these GHG, if the battery systems is not effective, if the battery storage systems are not effective in reducing the GHG by 80%, if it happens, to the extent that the use of battery energy system does not reduce. So their first priority is paragraph 1. First, they will buy battery storage system, and if battery storage system has reduced the GHG emissions by 80%, then they are not going to buy any carbon credits. But if the battery storage systems are not effective and they fail to reduce GHG emissions gases by 80%, then they will buy these carbon credit certificates. Sometimes we call it certificates. Then they are going to buy carbon credits. They are going to donate in carbon credits certificate to reduce the environment, to reduce pollution from environment, to reduce GHG emissions from environment. But this thing, just think technically, this carbon credits certificates, the buying of carbon credit certificate is only dependent on a future event, that if storage systems, battery storage systems are ineffective, then they will buy. So right now there is no obligation. It is dependent on any future event, that if that thing happens, if this battery storage systems are ineffective, then only they will buy this carbon credit certificate. So again, very simple, no present obligation and no obligating event for this, carbon credits. Okay, but now see, they are making us fool. It will buy these on the final day of each accounting period. These are the future cost, 3.78 million. Okay, so how much provisions they have made? They have made the provision of this 10 million, this 10 million, and the second is 3. So total provision they have made is 13.78 million. Total provision they have made is 13.78 million, right? these two provisions they have made? And the answer is you cannot book provision for anything now. Both provisions are wrong. Both provisions needs to be reversed. Both provisions needs to be reversed. Now let's move to the requirement. See, this is the requirement. See, requirement number A, 5 marks. And this time, even in my last attempt, if you see the last attempt pre-mock, I also discussed with marks. 1 mark per point, 1 mark, normally 1 mark per relevant point. So I will teach you with marks, with marking scheme, I would say, that where you are going to score, how you are going to get the mark. So using exhibit 1, first requirement is very easy. Be confident. Using exhibit 1 and in accordance with IS 37 provisions, contingent liabilities and contingent assets, explain whether Aderinto was correct to recognize a provision for the cost of its strategies to reduce greenhouse gases emissions in its financial statement for the year ended 31st December X5. No, it's wrong. Now, before wasting a time, let me show you the solution. I have written some pointers how to answer it. So in this way, we can save our time as well. Listen, first of all, you need to write the criteria of IS 37. To make provision, there are 3 conditions: present obligation, the chances of outflow must be probable, and there should be a reliable estimate. So if you write properly this whole criteria, you will get 1 mark. This is the state the rule. Okay. Now, then you have 2 marks. Listen, now total 5 marks available. 2 marks will spread for the battery storage system issue and 2 marks for carbon credits. Okay. So now you have written you can't make a provision if that thing can be reversed. That thing can be anything which can be reversed with your wish. Okay. You can't make the provision because then you can do the creative accounting or window dressing. There is no, now this is the application thing. There is no present obligation to buy battery storage system because Aderinto can simply back off from its decision by not buying it. See, this is the evidence. Only director's announcement cannot create a present obligation. Now, also, well, this is the heaviest point and this is 1 mark. See, this is 1 mark. This is the heaviest point that they can take U-turn. Also, one extra point I have discussed here. Also, no probable chances of outflow because Aderinto will get future economic benefits. See, in the question we studied that the company will be in profit. After doing this 10 million investment, still the company will be in profit. So company is getting more inflow as well. So it's not like a penalty thing or something which is pure outflow. So company is also getting economic benefit. So because Aderinto will get future economic benefit, that battery storage system plus profit from this project. Use your brain. They have made the entry P&L debit provision credit. See, they have made the entry P&L debit 10 million and provision credit 10 million. I can raise one point. Why did they debit P&L? Although this provision is wrong. This credit side provision is not possible here according to IS 37 because there is no present obligation. But why did you debit P&L? Because in return you are getting asset. In return you are getting battery storage system. So normally it's not allowed, but still you should have been debited asset debit and provision credit. Although that provision will also be wrong, but why did you debit the P&L? So this entry is perfectly wrong. This entry is totally wrong. So it needs to be reversed. Okay. I have raised 2 points with 2 marks. Now total 3 marks we have scored. 1 mark here. See the second and third. 2 marks in the battery storage system. You can write here the heading. For better presentation, it is ideal to give heading sentence, heading sentence, heading sentence. It will be easier for examiner to mark. Now, there is no present obligation to buy carbon credit because it is only needed. Simple, very simple. It is only needed if battery storage system are not effective, if they are failed to reduce GHG emissions by 80%. So it's a future thing, right? So obligation is only created if it fails to reduce net GHG emission by 80%. So it's dependent on future event. Okay. Now, what is the conclusion? 1 mark more you have get and 1 mark for the conclusion. That's why no provision needed for both events. So company needs to reverse 13.78 million provision and increase profit by this amount. So if you reverse the provision, so entry will be provision debit and P&L credit. Entry will be provision debit and P&L credit. Okay. So dear student, this is how you can score 5 marks for this requirement. 5 marks for this requirement. Okay. I hope you understood it. Don't sleep. Be active. Now the next part is IS 40. Next part is IS 40 and IS 2. IS 40 and IS 2, something like that. Okay. Aderinto, and that part you used to do in FR level as well, even in SBR level, change in use. Topic is change in use. Okay. Aderinto constructs apartment building. It sells some of these and hold to others to rent to the university student. Okay. Some buildings they sell it. Okay. So for that building, IS2 inventory. If you are making or buying something, if you are making or buying something for resale, then you should apply IS2 on it. You should apply IS2 in it inventory. But if you are making something to rent it, then IS40. Then ultimately, finally, IS40, you will earn rental. So finally, IS40 will be applied. Okay. Now, Green Bank is an apartment building which has been rented to university students. Okay, IS40. IS40, it meets that means Green Bank meets the definition. Green Bank meets the definition of IS40. Okay. Now see this question is in front of you. On 1st May X5, Aderinto's management decided that it would not rent the Green Bank apartment building to students in the next academic year. Listen, right now the building has already been given on rent to student, but now the management is planning. Management is planning that in future we no longer give this apartment to student on rent. So they are planning to seize. They are planning to seize IS40. IS40. They are planning to stop using IAS40. Be careful. And would instead remodel the building and sell it as a single property in the ordinary course of business. Okay, so this topic is IS40 to IS2. IS40 to IS2. Remember, you have done these questions, these things in your classes. Change in use. Change in use. Sometime IS40 to IS16, 16 to 40. Sometime IS40 to IS2. So it's a jump. It's a jump from IS40 to IS2. Now, but you know what is the requirement of standard? Standard says it's okay. You can jump from IS40 to IS2, but you need to show some evidence that you are not lying. You need to give some evidence that in reality you have planned to sell this asset. Okay, so that evidence is needed. And just listen to me, just merely saying that we are planning to sell it, it's not an evidence. It's not an evidence. It's not an evidence. So at 1st May X5, the criteria not met. See, it is written 1st May X5. Aderinto management decided it would not rent. Just this decision, just these words of management are not enough to prove that you are planning to change in use. You need to give some evidence. Now, see the evidence is development work. See, the remodeling started on, yes, this is the evidence. This is the evidence. It is written in IS 40. It is written in IS 40 that if you have given the evidence, if you have given the evidence, if you have given the evidence, and this evidence is this part, that you started remodel it, you started developing it. Normally before selling it, we renovate it. Before selling our property, we do coloring and we fix things. So yes, this is a proper evidence to auditor that we are serious and we are going to sell it. Okay. So in this question on the screen, you can see that 1st July X5 is the date. 1st July X5 is the date when you are going to shift it from IS 40 to IS 2, because you got that, you gave the evidence to auditor. After all students had vacated the building and the cost at a total cost of 350,000. The cost of this remodeling, this renovation is 350, upgrading. Aderinto began to market the building for sale on 1st October X5. Now, don't say that this is the date when you will shift it. You have already shifted it. You have already shifted on 1st July X5. So 1st October X5 is not the date of shifting entry. It's already 1st July X5 when you gave the evidence. The building remained unsold on 31st December X5. That means the building is under IS2 at the year end. The building is under IS2 at the year end because we have already shifted. We have already shifted this building to IS2. We have already shifted this building to IAS2. Now selling costs are expected to be 90,000. Yes, you know, in IS2 we have to calculate NRV. NRV is selling price or fair value less cost to sell. Selling price and fair value less cost to sell. Remember? Okay. So we need to calculate the NRV at the year end. Now, what is the fair value at the year end? At the year end, you need to bring it to, see, this is the fair value at the year end. Can you see the screen? See, this is the screen. So at the year end, if you want to calculate NRV, it will be 1.75 million minus 90,000 is the cost to sell. Okay. Although I know I am writing at one end I am writing millions. This is million and this is just pure 90,000. So 1.75 minus 90,000 will give you, I think, $1.66. So NRV at the year end, 90,000 means 0.09 million, 0.09 million. So 1.66 is your NRV at the year end. Just for your easiness, I have calculated it. At the year end, the NRV is 1.66, 1.66. Okay. Now, Aderinto measures the owner occupied property using revaluation model and adopts a useful life of 30 years for building. Right now, there is no discussion of IS 16. Owner occupied property. Please don't sleep. Owner occupied property means IS 16. So there is no discussion on IS 16 right now. But yes, it measures investment property using the very important fair value model. So when the fair value model is used, so at the date of change in use, now listen the rules. First, listen the rules. For example, we all know that 1st July X5. Please concentrate, you will understand. At 1st July X5, this is the date of change in use. As we are using see, previously we were using IS 40 fair value model. Okay, we were already on IS 40. So what standard says that now you are jumping from IS 40 to IS 2. Okay, now you are jumping from IS 40 to IS 2. So you need to bring your asset to fair value. you need to bring your asset to fair value using existing IS, using the last IS. You need to bring your asset to fair value using the last IS, and all changes according to the last IS 40. In IS 40, when you bring the assets to fair value, all changes goes in PNL. All upward and downward changes goes in PNL. Okay. So the first step is you need to bring it to fair value at 1st July X5. Now, this fair value will be treated as deemed cost. Now, this fair value will be treated as deemed cost for IS2, or you can assume it that you bought it from the market at fair value. Simple. Just think, on 1st July X5 you went to the market and you bought a property at fair value. So that fair value will be cost for IS2. From now onwards you will purely apply IS2. So one thing is this fair value will become cost. Now one more thing. Have you studied IS2 in your life? Yes. In your F3 level, FA level, FR level, basic level you have seen. So, in IS2, there is a topic, if you read the book, in IS2, there is a topic cost of inventory, how to calculate cost of inventory. So, it is written clearly that the cost of inventory includes original cost or purchase price plus all directly attributable cost, to bring inventory to its location. Okay. So, that means the remodeling cost is also part of that inventory. Remodeling cost is happening so that inventory can be sold, so that inventory can be liked by the customer. So it's like a renovation, it's like a upgradation, it's like a capital expenditure. So remodeling cost will be the part of IS2 inventory. The remodeling cost of 350,000 will be the part of this deemed cost, right? Right. And then in the end, then at the year end is 31st December X5. Year end is 31st December X5. Open your eyes. At the year end, you have to apply pure IS2, which says inventory should be recorded at lower of cost and NRV. Okay. So NRV I have just calculated with you 1.66 million. NRV at 31st December X5 I have just calculated with you, that is 1.66 million. And the cost means this fair value, which is the deemed cost, plus 350,000. This will be the cost of inventory. This will be the cost of inventory which I'm going to calculate for you. Okay. So this is the whole game which we have to do, right? So giving you 30 seconds or 1 minute to think over it. Giving you 30 seconds or 1 minute to think over it, please. You can just think over it and then I'll show you the question as well. You can take the picture of question, then I'll move the screen. Okay. See, this is the question. You can take the picture. If you want to take the picture, you can. Especially the fair values. Don't forget this thing, that the original cost of the building was 1.1 and it had, yes, a carrying value of 1.6. C at the date of change in use. At the date of change in use, it had a carrying amount of 1.6 millions. Okay. So we were already at 1.6 million on 1st July X5. So we will shift from 1.6 to 1.5. See, this is the fair value. This is the fair value of change in use date. Change in use. You remember the change in use date is 1st July. I already proved you. The change in use, the transfer date is 1st July X5. It's not 1st May, it's not 1st October, it's 1st July. because on 1st July we gave the evidence to auditor. We gave the evidence to auditor. Evidence is important in this area. It is written in IS 40. Just a practical question I want to ask. Why this is the requirement of IS 40, especially for this case when you are jumping from IS 40 to IS 2, that you need to give evidence to auditor that you really want to sell it. So why? Because in order to avoid creative accounting. Otherwise, what people will do, they will simply, in order to just book the gain, they will simply transfer it without any evidence. They will simply transfer it without any evidence. They will misuse this topic. That's why Standard Board has said that we need evidence. We need evidence. Okay. I would request you to take a picture of this whole so that I can move the screen, please. And it's not difficult. Don't take a negative thinking in your mind. Don't go simple. It's normal thing. Even it's a practical topic now. Normally in SBR they give you a lot of theories. It's a practical area now. Now read the requirement first. Read the requirement. See requirement number B. It's 10 marks. 10 marks. Using Exhibit 2 and in accordance with IFRS accounting standard, explain how Aderinto should account for the apartment building in the year ended 31st December X5. Okay. So now we have already discussed. It's time to take output and don't waste time. See this. First of all, you need to write definition of investment property, IS 40. What is the I've not written the definition here. You know that if you are buying a land and building for rental earning purpose or capital appreciation purpose, rental earning or capital appreciation or both, rental earning or capital appreciation or both. Normally these two objectives are simultaneous, right? So in this way also apartment building meets the definition of IS property. That's why the apartment building, the building which we are discussing, so see 1 mark we need to score 10 marks. So 1 marks we have obtained. Okay, I will try to give you the maximum marks breakup, but as it is a 10 mark question, so I might give you 9 marks or 10 marks or 11 marks. Okay, but major breakup I'll give you. Now just come to the point. Also in 2000X5, building is transferred to be sold in the ordinary course of sale, right? They plan to sell it. So this is a transfer from IS 40 to IS 2. Again 1 mark. You have identified the issue that this time they are transferring from IS 40 to IS 2 because now they are planning to sell it. So it's 1 more mark. Now see, this is again the criteria of IS 40. According to IS 40, this transfer only allowed or only possible when the building stop meeting the definition of IS 40 and there is an evidence I discussed of change in use. Management intention, or you say merely management intention in May X5 is not sufficient. It's not sufficient evidence to prove change in use, to prove change in use. Okay, so 1 more mark. I think we have scored 3 marks. 1 more mark. Okay, so that means on May X5 we are not making the transfer entry. Now IS 40 states that commencement of development, yes, they started remodeling it. They started remodeling the house. So it's an evidence that yes, they are serious. With a view of sale is sufficient evidence for change in use. That's why the transfer takes place on 1st July X5. We have give the green signal. Okay, one more thing, as fair value model is used in IS 40, that's why building needs to be recorded at fair value using IS 40. I told you at the date of change in use you need to bring it to fair value using the last standard. At the date of change in use you need to bring this asset to fair value using IS 40 using the existing standard. Okay. At the date of transfer with any gains or losses in P&L. Yes, we have discussed. Now this fair value will be deemed cost for IS2 inventory. One more marks. Okay. Now listen. That's why at 1st July X5 building should be remeasured at 1.5 million because the fair value, you can see the picture. I told you to take the picture. The fair value at 1st July X5 is 1.5. And you know what is the carrying amount? Wait, let me show you in this sketch. See, the carrying value at this date is 1.6 and the fair value is 1.5. Carrying value is 1.6 and the fair value is 1. At this date, see, at this date the building was already at 1.6 but the fair value is 1.5, so you need to bring down 0.1 million. You need to bring down your investment property by 0.1 million. As a student you may ask, sir, where it is written? Let me show you. See this. Carrying amount at the date of change in use is 1.6 and this is the fair value at 1st July X5. So from 1.6 to 1.5, from 1.6 to 1.5 there is a reduction of 0.1 million. There will be a reduction of 0.1 million. See this. That's why at 1st July X5 building should be remeasured at 1.5 million with 0.1 million loss, 0.1 million loss in P&L. And I have also made the entry. Okay. Now the remeasurement cost, the remodeling cost issue. Also according to IS2, inventories cost include original cost plus all directly attributable cost to bring inventory to its location. That's why deemed cost of 1.5 million plus 385,000. Remember, remodeling cost will be the part of the cost of building according to IS2, sorry. So 1 million, 1.5 plus 385,000 means 0.385. 1.5 plus 385,000 means 0.385 million. So the actual cost is 1.85 million. The actual cost recorded by you guys or actual cost recorded by us on 1st July X5 is 1.5 million for IS2, okay. Now finally one last thing. Now tell me, after 1st July, when is the year end coming? After 1st July X5, when is the year end coming? The year end is coming on, see this. The year end is coming on 31st December X5. The year end is coming on 31st December X5. So two things at the year end. Original cost is 1.85 and the other thing is NRV, which I have already calculated, which is 1.66. At the year end you need to keep two things clearly. The first thing is original cost and the other thing is NRV, because IS2 says inventory should be recorded at lower of cost and NRV. So these are the two things. Now you can better take the decision. Better take the decision. See, also at the year end inventory is unsold. See the screen. Also at the year end inventory is if inventory is unsold, it should be recorded at lower of cost and NRV. One more mark. And then finally calculate the NRV of building, which I have already calculated. At the year end the fair value, which is the selling price, is 1.75 minus cost to sell is 90,000, or you can call it 0.09 million. 90,000 means 0.09 million. So NRV will be 1.66 million and deemed cost is 1.85 million, including that remodeling cost. So if we record at lower of 1.85 and 1.66, so we need to book a loss. We need to book a loss of 190,000, 190,000, 190,000. Okay. On an inventory write down expense of 190,000 should be booked in P&L. Okay. So that's the end of this part. That's the end of this part. If you are active, I have almost discussed total 10 marks. See, 1 plus 1, 2 marks, 3, 4, see, 5, 6, 7, 8, 9, and 10. Total 10 marks I have discussed. Total 10 marks, 10 points I have discussed, and 10 points means 10 marks. Okay. So this way you can plan. This way you can plan. This way you can plan. Okay. This is very important for the writing of exam and to gain the confidence. To gain the confidence as well as score good, as well as helping the marker. If you are helping the marker to give easy marks, he will be very happy with you. Okay. So just a quick one, please. If you want to read it, just giving you 30 seconds to go through it so that you can recap it. See this. Okay. So now one last area is left and then our question will be done. One last area is left. See, this is the last area. Okay. So now this is the third area, social media influencers, social media practical area. We all spend a lot of time on social media, but there are people who are earning from social media as well. Okay. So a social influencer is an individual with credibility in a particular industry and a large following on social media. We all, nothing new, nothing new. So now our company Aderinto is going to hire, Aderinto is going to engage a social media influencer to sell these properties. Very common in all countries. I see that these social media influencers come to your property, they make a video of your property and they make it viral so that you get the clients and all. Okay. So on 1st November, Aderinto engaged a social influencer to build awareness of its brand and to promote new apartments in two buildings, River Park and Moore Place. These are the two buildings, okay, on social media influencers. So just to break it down, this social media influencer will give rise to the brand, will give a good voice for the brand, and as well as these two buildings, these two apartments. Construction of both buildings began on 1st October X5 and it is expected to be completed on 31st January X6. So it's like October, November, December, January. Okay. So it's like 4 months. In these 4 months, this guy will run the campaign. In these 4 months, this guy is going to run the campaign or like so, or it will take 4 months to complete the project. Aderinto intended to lease the 80 apartments in River Park to university students under 12 months operating lease contract running from 1st August X5 to 31st July X6. So very simple, very simple. River Park apartments we will give on rent. River Park Apartments we will give on rent for 12 months. So 12 months means now be a lessor, be a lessor. It's IFRS 16. IFRS 16. It's IFRS 16. As we are giving apartments on lease for exactly 12 months, so IFRS 16 lessor books, will apply, and yes, this 12 months lease is operating lease. This 12 months lease is operating lease. So we are giving our apartments on lease. And listen, and to catch these students, we are using influencer. To catch these students, or I would say to catch this operating lease agreement, we are giving commission, to this influencer. Okay, now there are total 80 apartments in River Park. Don't forget, be active with the number. It also intended to sell 60 apartment in Moore Place. Now, totally different. In Moore Place, we want to sell. Sell means IFRS 15. Revenue. But in River Park, it's IFRS 16. Be careful, please. In River Park, we are giving on rent. Don't sleep. In River Park, we are giving it on rent, operating lease, so IFRS 16. But in Moore Place, we are going to sell it, so it's IFRS 15. So some cost we are spending to get the operating lease contract in River Park, and some cost we are incurring to sell that Moore Place apartment. So it's IFRS 15. So both are different standard. This is the real game to pick the IS, to identify the IS. It's a big game in this SBR level exam. Okay. Now, to individual purchasers in the ordinary course of business, right? Okay. So 60 apartments with Moore Place and 80 apartments with River Park. Don't forget the number. Involve with me, please. Now, the contract with the social influencer had a term of 3 months, and Aderinto agreed to pay, number one, an initial fixed fee of 180,000. Now this fixed fee means it is not connected to any apartment. It's general. This is the general expense. This is a general expense, I would say, because it will give a boost to the brand as well. See this brand, and to promote new 2 buildings. But it is a fixed fee, you cannot allocate. You cannot identify it should be linked to brand or it should be linked to apartment. So it's a general expense. But now the next line you will see a exact variable things. Listen, 500 for each of River Park apartment lease contract signed as a result of the influencer promotional activities. Yes, if influencer will help us in getting River Park, influencer will help us in getting River Park operating lease. In River Park, it is pure operating lease agreement. Then we'll give him $500 per rental agreement. $500 per operating lease agreement. Be careful. Now, and $1,200 for each deposit received for Moore Place apartment as a result of the influencer promotional activities. Yes, for Moore Place, we are going to sell it. Moore Place apartments, we are going to sell it. So with each apartment sales through this influencer, we'll give him 1,200. Okay. So now B and C are specifically, B is linked to IFRS 16. Please. B is linked to IFRS 16. And C is linked to IFRS 15 because C is linked to the sale. Moore Place, in Moore Place we are selling. So these are the incremental cost of obtaining the contract. This now let's open it. This part of the question is purely linked to the cost associated in bringing the contract. Cost incurred to bring a contract. Okay. Cost incurred to bring a customer. Hope you remember this issue in IFRS 15. I will discuss. Don't worry. Now let's see. Now let's see how much sales they have done. This is the last part of the question. See, this is the last part. The variable fee will be paid at the end of the social influencers contract on 31st January X6. This is the payment date. Okay, payment date. But we need to say when this payment will be due. When this payment will be due. By 31st December X5, Aderinto, please don't sleep, it's a good part of the question. Aderinto had signed contracts to rent all the River Park apartments for the next academic year. It is signed, it is done. It could identify that 75%, yes, of these contracts were the direct result of the influencers' activities. Yes, yes, yes. Wait. So for River Park, let me calculate for you. For one apartment, we are paying how much? $500. For one contract of River Park, we are paying 500. And there were total 80 apartments. There were total 80 apartments. But can you tell me how many apartments are sold because of this social media influencer? 75%. Into 75%. Just multiply it. Just multiply it. 80 apartments multiply by 75%, multiply by per apartment we are paying 500, so this will be $30,000. Okay, so we have to discuss this $30,000. $30,000 we have incurred $30,000 to obtaining these operating lease contract. Now if you have studied, don't read further, first listen my lecture. If you have studied IFRS 16, if you have studied, dear student, IFRS 16, then any cost, listen, any directly attributable, this is directly attributable cost, this is a traceable cost. Any directly attributable or traceable cost incurred in getting operating lease contract should be capitalized, as a part of underlying asset, and this time underlying asset is IS40 investment property. And now this cost will be amortized over the lease term. This cost will be amortized over the lease term, but the lease term is only 1 year because we are giving students apartment for 12 months. So this cost will be spread over 12 months. This cost will be spread 30,000. Wait, listen to me. Divide by 12. So 2,500 per month we need to book. 2,500 per month you need to book. I repeat. IFRS 16 says if you are incurring any directly attributable cost in bringing operating lease contract, so that directly attributable cost will be capitalized now and it will be part of the underlying asset. So in this question, the underlying asset is IS40 investment property. Okay. And now this asset will go in the P&L when we'll earn the rental income. When we'll earn the rental income, so it will be matched with the rental income. It will be matched with the rental income every month. So we are earning rental income. In the previous page, I can show you from 1st August X5 to 31st July X6. So every month we are going to book 2,500 per month expense. Let me show you. See this part. Dear students, these are the 12 months for which we are earning the income. Okay, so this is for River Park. Now it's my wish to first discuss the River Park with you, and then I'll discuss, see this, from this area to this area I'll discuss the Moore Place. Moore Place is also very easy. Moore Place is also very easy. First let me discuss River Park. See, this is the requirement, again 10 marks, again 10 marks. Using the Exhibit 3 in accordance with IFRS accounting standard, evaluate the accounting treatment applied to the amount paid to the social influencer. To the social influencer. Okay. See, this is the, I have written some points for River Park. See, first of all, we are discussing River Park. Total total three areas we need to discuss. One is river park variable fee, one is Moor Place variable fees, and the third is fixed fee. Fixed fee of 180,000 we can also discuss. See, as river park rental contracts are operating leases, yes. So it is in scope of IFRS 16. Go very in simple terms. You have to write in basic English. River park rental agreements are operating leases. It's 12 months exact. So it is in the scope of IFRS 16, and standard says any directly attributable cost of obtaining operating lease contract must be the part of underlying asset. And in this question, underlying asset is IS 40. Okay. So I would say like 1 mark you have discussed here. Okay. Now, total commission payable to influencer will therefore be part of underlying asset investment property. So what is the commission? 500 multiplied by 75% into 80. So it will be 30,000. One more mark. And now this 30,000 will be, now tell the treatment. Now this 30,000 will be booked in P&L when lease income of this operating lease is recognized in the P&L, that is from 1st August X5 to 31st July X6. Whenever you are going to hit the income, rental income in your P&L, you will book the expense as well. So expense will be 30,000 divided by 12, which is 2,500 per month. This is the 1 mark more. So 3 marks you discussed for river park. 3 marks you discussed for river park. I would request you to calm down and read it. Calm down and read it. See, in the first part you connected it with IFRS 16. Yes, it is IFRS 16 because you are renting the river park apartment. So rental you are earning, you are a lessor. You are a lessor and you have given on operating lease. So IFRS 16. Then you discuss about this cost of obtaining the lease contract, because through this social media or influencer you are getting clients. You are getting clients. You are getting investment property contracts. Now the next part is, yes, this is the next part which we have skipped. This is Moor Park. Moor Park is about sales. Now we are selling. Now this influencer is helping us to sell, helping us to getting the customer of sale. So IFRS 15, now IFRS 15. It had also taken customer deposits. Yes, and when you sell the Moor Park house, Moor Place house, customer will give you deposit, and once the customer will give you deposit, the commission of influencer is done. The commission of influencer is confirmed. Okay. It had also taken customer deposits on all of the Moor Place apartments and could identify that 50% of these sales were the direct result of the influencers activities. Okay, now wait. How many total apartments? How many total apartments of Moor Place? Let me see. Moor Place total apartments are 60. Yes. See this. Moor Place total apartments are 60. Okay. And for one apartment, we are paying 1200. Now wait. What they are saying? They are saying 50% of these sales. So total apartments are 60 multiplied by 50%. That means 30 apartments multiplied by per apartment. We are paying $1,200. Per apartment we are paying $1,200. So 30 multiplied by 1,200, it's $36,000. It's $36,000. Right? It's $36,000. Now you tell me, Simple. This $36,000, very simple summary. We are paying to obtain. We are paying to obtain the sales contract. Okay. So IFRS 15 clearly says incremental cost, we are, whatever incremental cost you are incurring, whatever incremental cost you are incurring to obtaining a customer should be capitalized, if that cost is recoverable, okay. Now this cost will go in the P&L. This cost will be amortized, or I would say will be amortized in the P&L on the, if this is a service contract. For example, it's not a service contract, it's a sales, pure units we are selling. But just think, if it is if it would be a service contract, then spread it over the life of that contract. But my dear student, this time you are selling apartments, and you are selling apartments in just few months. You are giving possession in just few months. You can see, let me show you. See this. Construction of building. See this. Construction of both buildings began on 1st October X5, and it is expected to be completed on 31st January 6, almost 4 months. Or I would say 3 months, because we engaged the influencer on 1st November. See, we engaged the influencer on 1st November. So November, December and January, just 3 months. Yes, just 3 months, November, December and January. In 3 months, all the sales will be done. So you can book the asset. There is the first treatment. You can book the asset on when this sale is confirmed, and the moment you will be booking revenue, in the P&L, because it's all matching principle. You can match this expense, this amount, this asset in the P&L as an expense. I repeat, listen. The influencer started the activity on 1st November. You can see the date. And November, December, January, within 3 months, or you can say by 31st December X5, within 2 months. See, Aderinto had signed the contract, and yes, it has also taken customer deposits. So everything is sold in just 2 months. Okay. So now, as this cost of 36,000 we are incurring to obtaining the customer, and thus real sales will be hit in next month. The real sales will be hit by 31st January, because by 31st January we'll give the possession. So we will be booking the revenue by 31st January. So the first option is you book an asset now, and you will amortize over the term of the contract. But term of the contract, these are goods, not services. In more place, it's services, it's goods, not services. So you will be booking the complete expense next month. Okay. So this is the first option. There is one more second option, which is IFRS 15 has given. Please listen. This is the practical expedite, we call it. That in case special exemption IFRS 15 has given, in case you incur a cost in obtaining a customer, listen, and that sales contract is less than 12 months, which is the case here, then you don't need to book any asset, directly book it as an expense. If it is less than 12 months, which is the case, so it is allowed, you can directly book as an expense. So both options are good. Book an asset now in December X5, and very next month on 31st January, when you will be delivering units to customers, then you will book the revenue. And whenever you will book the revenue, you will expense this cost as well. So both options are perfect. Okay, both options are perfect. Let me now I need to write some points as well. See this. First of all, you identify IFRS 15 should be applied here, as it is connected to revenue booking. Very simple. Why? Because Moore Place apartment, we are going to sell it. Standard says incremental cost of obtaining a customer should be capitalized if that cost is expected to be recovered from customer. This is the general rule of IFRS 15. Okay. This cost should be amortized in P&L on systematic basis with respect to goods or services are with respect to when goods or services are transferred to customer, right? Now, as in this case, within 12 months, these apartments will be transferred to customers, so the time period is less than 12 months. So IFRS 15 allows a practical, expedite to book such cost immediately in P&L. Okay, if it is less than 12 months. So this option we can also avail. We can also avail. Otherwise, that thing is also perfect. The second option is we book asset now and transfer this. Let me write the 36,000 amount. It's $1,200 multiply by 60 units into 50%. Okay. In the P&L on 31st January X5, when at the time of delivery of these units. Okay, so this is all 3 to 4 marks area for Moore Place. This is for Moore Place. This is 3 to 4 marks area for Moore Place. Now you tell me how much assets, if I purely do accounting of asset. So if I go for asset option, listen, this is the asset 36,000 we have booked by the year end. 36,000 please. And this is the asset 30,000 is one more asset we have booked. So 36 plus 30, total 66,000 asset we have booked. 66,000 asset we have booked by now. 36 plus 30, 66,000 asset we have booked by now. But what they have done, listen, see their wrong treatment. They have booked 246,000 asset. See this, they have booked 246,000 asset. Aderinto has recognized the selling assets in its financial position. So in the end of this question, you need to say against one line. You need to say that 30,000 is the first asset and 36,000 is the second asset if we go for the asset option with the IFRS 15. Okay. Now the last thing which is left, can anybody tell me what to do with the fixed fee? What to do with the fixed fee of 180,000? See, this is not the biggest point for this 180,000. This is not directly attributable. This is not directly attributable. This is not directly attributable. Now, if I will just discuss shortly. Then you need to write yourself, and I would request you to send me this question for marking as well. To solve this question and send me for marking as well. Listen. Fixed fee. Listen, students. Now I will break up the fixed fee of 180,000, okay, and this guy is doing marketing for 3 months, November, December and January, don't forget, and January. These 3 months he'll do campaign. Now this fixed fee will help us in improving the brand. This fixed fee will help us in improving the brand. Yes, this fixed fee is help us in selling the inventory. So IS2. This fixed fee will helping us to rent our investment property, IS40. Listen. This fixed fee will help us in selling inventory. Selling is IFRS 15. Just this fixed fee will helping us getting the rental agreement, that is IFRS 16. So I would say it's a general cost. Please make up your mind. Make up your mind. You are no more kids. You are professionals. It's strategic business reporting, strategic people. So this fixed fee is not a directly attributable cost at all. This fixed fee is not a directly attributable cost. It's a fixed fee which will help your brand to grow, which will help your inventory, which is help in selling your inventory. So it could be related to your inventory. It will help in growing your investment properties. So IS40. So this cost is incurred for it's a general cost and you cannot directly relate it. The major part is you cannot directly relate this cost. You cannot directly relate this cost at all to any single standard. You cannot directly relate this cost to any single standard. Okay, right? So this part you have to do it yourself. Just I am giving you cannot directly relate this cost to any specific standard. Okay, now when it is not a directly attributable cost, now you need to write the criteria in IS. First of all, in IS40 says to record. IS40 says at initial recognition we record it at cost, original purchase cost plus all directly attributable costs. So this is not directly attributable cost, that's why it should not be the part of IS40. Same is the case with IS2. IS2 also says to record at purchase price, to record inventory at purchase price plus all directly attributable costs. Again, this is not directly attributable cost. Even it's a selling cost. It's a selling cost. And you know, those of you who have studied IS2, it is clearly written that selling costs are never part of inventory. Selling costs are never part of inventory. So that's why this cost does not belong to IS2 as well. The major point is that it's not directly attributable. Also, for IFRS 16 and IFRS 15, it is also written that the cost which should be capitalized must be directly attributable. So it's a general cost. So what is the treatment? After discussing all this thing, you will write that this is a general expense of 180,000 for 3 months. 180,000 for 3 months, November, December and January. So 180,000 divided by 3 will give you 60,000 per month. So what you will do, 60k, 60k and 60k. Okay, so by December you will be booking, by December is your year end, by December year end you will be booking 120,000. by December year end you will be booking an expense of 120,000. Okay, but that stupid guy I would say they have recorded it as an asset, which is wrong. This is simple marketing expense. This is general marketing expense, and general marketing expense goes in the P&L, right? Okay, this is not the major hit. The major selling point is this is not directly related. You cannot directly relate. It's not attributable cost. This is not directly attributable cost. Okay, right? So this is how you will approach this area. I'm sure you learned new things in this question. If you like this question, please comment on the comment section of the YouTube. You can share it with your friends, and you can watch the other lectures which I have recorded. So it's time to say goodbye. Take care.